I'm Connor Dolan. I work with Unchained, VP of Sales. Been with Unchained since 2021. A lot of changes have happened over that time. One thing that's remained consistent is our lending business and the importance of Bitcoin lending services in the broader financial services space. Unchained, for those aren't aware, is a Bitcoin financial services company that focuses on custody and eliminating counterparty risk while having access to financial services like loans and IRAs and trading and all that.
Thank you. Hey everyone, my name is Himanshu. I am the co-founder of Arch Lending. We've been in business since early 2022, really in the wake of companies like BlockFi and Celsius, etc., falling, and we're working on really building a holistic wealth management, private banking experience for people that have significant digital assets. So our first product was the Bitcoin-backed loan. Been doing that for almost 4 years now. And now we've built other services on top using the foundation of lending to provide use cases in retirement, tax planning, etc. So I would love to speak a bit more about that today. And good to see everyone.
Hey everybody, Matt Dines. Any show of hands, who was here last year? I did a talk in October. It's great to be back here at the space. My firm is Build Asset Management. We're a buy-side fixed income and credit manager. What does that mean? We own the risk. We deploy dollar capital into the Bitcoin-backed loans to fund access to households, businesses, corporations, et cetera, who reserve Bitcoin on their balance sheet to access dollar liquidity and reinvest into the economy and do great things. So yeah, that's how we're getting started.
And we have to give Matt here a ton of credit because you saw this place when it wasn't nearly as pretty. And so we made a few upgrades since you were here last. Yeah, our first presenter. I don't even know if we hit the stage.
It was a hit. The only downside that night, we went to the opening night of the Denver Nuggets and Oklahoma City Thunder last year. It was a foretelling, I think, of the way the season would go.
That's right. So I kind of want to start with basics here, Himanshu. I was wondering if you could just break down for the audience how these Bitcoin-backed loans are structured.
Yeah, so I can speak to how our structure works. So we focus on a high level of security and transparency with the structure that we have, which is we hold all assets in qualified custody. We specifically use Anchorage Digital, where your assets at bankruptcy remote from us, from Anchorage, they're insured up to $100 million in value. We're actually launching a unique insurance product on top very soon, where you'll have insurance against rent attacks and such as well. So that should be coming out very, very soon. But the way this works is your assets can be segregated. So you come in for, say, a $200K loan. We'll segregate your Bitcoin, share the address with you to make sure that we can prove that we're not rehypothecating any assets and we're not using them for anything beyond just holding them for our security. Our capital comes from a more traditional debt structure called a CLO, a collateralized loan obligation. And that structurally does not even allow us to rehypothecate. So that's on the security side. Our terms go up to 2 years, and we really focus on providing a flexible way for you to manage your debt. So as Bitcoin goes up in value, you can upsize your loan. You can keep rolling over your loan as often as you'd like. And really the focus is on providing as much flexibility and security to you as possible, because as we've all seen, the lending space has had some booms and busts, and I think it's important to learn from the mistakes of people that have done it before and do it right now.
Yeah, Connor, I'm kind of wondering if you could touch on Unchained a little different on the custody model, how that looks from your guys' point of view.
Yeah, absolutely. The Bitcoin lending space is still new, but there are a lot of different solutions out there already. And the different solutions have different custody models and different trade-offs associated with that. Unchained's custody model, everything that we do at Unchained is really built on multi-signature custody, which for those that aren't familiar, at a high level, multi-sig gives you the ability to build addresses with multiple private keys associated with it, as opposed to just one. And multi-sig is the foundation and backbone of every institutional custody that you can imagine. It's just that we are utilizing the Bitcoin network to give clients access to this functionality of Bitcoin as well. Part of multi-sig allows us to create a really unique solution within the lending space. And so as a client of Unchained, the foundation is 2 of 3 multi-signature custody, meaning that we're building an address with 3 private keys, and you need any 2 of those 3 keys in order to move the Bitcoin. Now, if you are utilizing our product for your own self-custody and you are utilizing a client-controlled model, that means you're holding 2 keys and Unchained holds 1. You can kind of think about it like a digital safety deposit box with 2 keyholes, 3 keys, and you need any 2 keys to open that box. If you're in this self-sovereign model where you're holding the keys, you have 2 keys, Unchained has 1. If you're doing the math in your head, with 1 key, we can't move that Bitcoin. But as a client with 2 keys, you have unilateral access to the Bitcoin. But of course, if one of your 2 keys were ever lost or compromised, you can always use Unchained as a second signer. Great way to store your Bitcoin for long-term storage. And it also makes the lending solution possible, which is actually the first product that Unchained came out with way back in 2017, which makes us one of the oldest Bitcoin lenders in the space. Over $1 billion of Bitcoin loans originated over that time period. To go back to answer your question, why I walk through all of that, because that's also the foundation of our lending solution. It's still 2 of 3, but as a client, of course, you can't hold 2 keys because then you would have access to the Bitcoin and the dollars that we lend you. But uniquely, you do have the option of holding 1 key. And that 3rd key, importantly, isn't held by Unchained, but we actually enlist a 3rd party to hold that 3rd key. So Unchained still doesn't have the ability to move the Bitcoin or rehypothecate it. And the way that that lending solution works, I put my Bitcoin up as collateral in this 2 of 3 address. I have 1 key, Unchained has 1 key, 3rd party key agent holds that 3rd key. And assuming I pay back my loan, I'm fulfilling the obligation. I use my key and Unchained's key to move that Bitcoin back to the address of my choosing. That 3rd key only comes into effect here if you enter a Bitcoin loan, Bitcoin's price goes down, and you enter a margin call, and you're not fulfilling your obligation on the loan, which is very uncommon because clients want to keep their Bitcoin. That's when we would use that 3rd key to unlock that Bitcoin and make sure that we don't go underwater on our end. So slightly different structure than what Arch is doing. And again, there's trade-offs across the board. But that's the foundation of Unchained's lending service in terms of multi-sig collaborative custody, where you actually get to still be a key holder in that arrangement and verify on the blockchain that that Bitcoin is actually there.
All right. How many people followed everything you just said? All right, great. Awesome. So
That's surprising.
yeah, there's going to be a pop quiz in a second. No. All right. So you think about everything Connor's talking about on the back end, actually working, and who in this room has gone through the process of signing a 30-year, 15-year mortgage, something like that with a bank? Like, show of hands. Everybody's been to, like, a lot of docs being signed, right? But most people don't know what each one of those pages is doing on the contract, but what you're doing is you're forming and perfecting a loan, like, with the collateral, and you got a future stream of payments, the IOUs. You involve the bank, the borrower, and potentially an insurer in the middle, different parties. But that's what all those pages are, and you're forming an asset. Like, it's coming out of thin air. That process is the money printing. Unchained right now, not a bank. They can't just print the money out of thin air. To fund the loan, it's got to come from hard equity dollars. But everything Connor just talked about with the Bitcoin and collateral, it anchors extremely well into this process of creating a loan asset. Now, the banks aren't there yet where they can literally do the fractional reserve money printing that everybody, look at all these, the artwork on the walls has made clear. We all understand that, right? But when we're talking about like forming an asset, a credit relationship, everything Connor just talked about with like the uniqueness of what Bitcoin offers, like the UTXOs, the credibility guarantees of monetary policy, all of that, those Bitcoin are actually tied into the loan document itself as collateral. Now, it's a different world when you get into other, pseudo credit assets, like, what we've seen come out from, say, a Bitcoin treasury company, exchange listed preferred shares. Different thing. You're actually, I talked about the sandwich, the Bitcoin collateral in an Unchained loan. It's actually like tied to the loan documents. You have a couple of presenters coming up here after us talking about UCC Article 12. this is the level of due diligence that, like, to actually own the risk in this space, you have to understand and be comfortable with, or to get your head around. You don't have to be a lawyer, but you probably have to pay a lawyer to review this for you. My point there, these loans are different. They're actually minimizing the amount of counterparty risk in a credit relationship, right? And as you keep adding those on, the more risky technically your credit becomes, because with every counterparty, that's another layer of failure. Like for me as a buy-side manager, which just means we own the bonds, we own the loans, our clients can potentially face a point of loss. So we want to reduce those to a minimum and just unchain with the culture, starting with their corporate leader, like their exec team at the top, down to the Connor Domans who reach out to everybody on the front lines. That stands out in their corporate framework. Probably Arch the same. Can't speak as deeply there, but what I can say is this focus here: get the UTXO attached to the loan. It's a totally different thing when you're thinking of Bitcoin-backed credit, or the latest narrative that I'm seeing spin up digital credit. If you're doing an exchange traded preferred, where do the UTXOs come in? And you go through, what do you actually own if you're buying something else? It may be, oh yes, it's a securities offering. It has a prospectus. Where is the actual collateral? Where do the dividend payments come from? Where does the interest income come from? Dig all the way down. Basically what Unchained is doing and Arch is doing at some level, there's different ways to skin the cat, but you're minimizing the risk in between all of these different counterparties, between the borrower at the end and then whoever owns the loan. And for Unchained, some of their loans are financed to other parties. So as a lender entering this space, you have to understand that entire hierarchy. So what Connor and Himanshu describe what they're doing, different approach to everything else you may see in market that may pass as Bitcoin credit or DeFi or stablecoin lending. So it is an area where if you want to get involved, you do have to do your due diligence and understand what you own. It's a very extensive and detailed process.
No, I think that's beautifully said, Matt, and great insight there. And you're curious from your perspective too, kind of higher level, capital provider, in this industry. Is reading a report from Galaxy. Little data came out the end of 2024, but they were stating, that 21, 22. Unfortunately, when we had the collapse of BlockFi and Celsius, and really unfortunately a stain in the industry from just poor business ethics. The peak of the crypto lending market got to around 42 billion. At the end of 24, we're standing at about 35 billion, lent out. How are you kind of seeing the market move forward after kind of learning these lessons from the past?
We tend to learn lessons in credit one cycle at a time. I think the masses, and this is just everything, whether it's subprime mortgages, asset-backed security, you're seeing, even JP Morgan caught up in, just like Tricolor, subprime lending to undocumented migrant populations, what could go wrong, right? Or First Brands, where an auto parts supplier did invoice-backed borrowing, which turned out to be pledged 10 times over, per se. Smart people make a lot of dumb mistakes, and I think as credit, like by definition, you don't have upside. You're going to be senior. You won't be the risk layer of a capital structure. But what you have to make sure in that is by giving up upside, you have to make sure that you're not actually taking on that downside risk. So you have to be extremely careful. A lot of us, just make mistakes every cycle. And I think the point in not just Bitcoin and credit, but all credit, just don't be caught in the bottom.
Don't be caught on the bottom. And then Connor and Himanshu, you guys actually playing the role of loan servicers and originators. You want to touch on some of those lessons learned and how the business is different?
Yeah, I think one of the key lessons learned was we haven't still figured out how to do rehypothecation correctly as an industry. And it is a pretty common thing that other industries do, but they have different backstops that we don't. So as of now, I think it is very important to not rehypothecate and to really hold collateral safely. And I think we both have different models, but they both focus on really keeping your assets secure, making sure that you can get them back at the end. If you want to end your loan today, you will get your assets back today. That needs to be an utmost, it has to be a given. But I think besides that, we've also learned how to raise capital. A lot of the lenders in the past, just speaking to the blow-ups, were taking retail capital on one end for deposits and then lending it out further to give yield to one side and then to give dollars to the other side. That breaks in a scenario where there's a bank run and one side wants to get the money back, but it's not been given back by the other side. Or you've taken your Bitcoin, lent it out, and then you want to come back and get your Bitcoin because you want to end your loan, but the Bitcoin's not there. So that also creates issues of duration mismatch, which you probably look at a lot. So you really want to make sure that you have stable long-term capital. You have really tight ways to make sure your collateral is where you say it is. And also you need to make sure that in the event of something going wrong, the borrower at the end of the day is protected. So for us, the way we do it is we have a backup servicer. So if something were to happen to us, let's say tomorrow Arch goes under, your loans are still completely fine. They'll be serviced through the end of term, and you'll get your Bitcoin back at the end of that because the Bitcoin in the loan is still titled to you, not to us.
Great answer. And do you want to expand on that, Connor?
Yeah, I don't have too much more to add. I would say, I think, as early as we are in Bitcoin, which we are still very, very early, it's that to the nth degree within lending. We're that much earlier in terms of where that adoption is right now, which is why the rates are what they are, because the broader credit market doesn't understand the value and how pristine Bitcoin actually is as collateral. I guess my point of that being, I think a lot of the bad actors got flushed out, and when I'm talking about that play stupid games, win stupid prizes. A lot of the lenders in the space that blew up, they did it because they got greedy and carried out unsustainable business practices. And so, yeah, I don't have too much more to add besides the fact that I think we'll continue to mature. It probably won't be the last time you see a lender blow up. And that's why it's really important to conduct due diligence when you're looking into this and making sure that you are comfortable with the risk you're taking and the custody model you are using. If it is a lower rate, there's likely a reason for that. And it doesn't mean you should avoid that product completely, but there's a trade-off everywhere you go. And not surprisingly, Unchained is one of the highest rates in the space, but that's because of the custody model that we enforce.
Yeah, no, that's a great segue. And play stupid games, win stupid prizes is one of my favorite sayings. So thank you for integrating that into our talk. But yeah, we have a lot of inbound interest from our clients right now about exploring these processes. And we really do emphasize like the due diligence involved with identifying and evaluating different servicers and originators. And you kind of touched on it, and Connor, I'll just throw it to the group here. But a lot of things I hear from Bitcoiners, and frustration is probably not the right word, but much higher rates and traditional lending. And so I think there's probably some textbook understanding is like as more competition come online, that will be kind of a driver of pushing rates lower. But what do you guys see kind of from the macro perspective on what would lower or raise rates?
I think, as Connor touched on, this is still a very new asset class. So the capital coming in is coming from traditional finance that still doesn't truly understand this. We were talking earlier about how one of your structures was rated, and it was an A- when I think it should have been a AAA. And that's just a rating by a ratings agency. So in a structure like this, as a lender, it's the most beautiful structure. It's the most liquid collateral, trades 24/7, 365, can be stopped. There's no way for you to have a loss, really, especially because your loans are all over-collateralized. As a result, I think when this becomes more and more commonplace, and as I think banks come in and really are able to provide capital directly from a bank, which will obviously be the cheapest capital, the rates will come down. We are obviously seeing a macro environment where the federal funds rate is coming down, but also as the book sizes grow, you're able to command lower rates. Our rates, for example, have gone down from last year, we were at 16.5. Today, we can do 9.5 onwards to like about 12.5. And it's just a function of increasing book size, being able to leverage the higher amounts into lower rates and pass that benefit off to the borrower.
Yeah, I think Tamashu mentioned there, rates are coming in. I know maybe it doesn't feel like it in a bond market that, we just went through 2022, 2023, like the worst years for a bond market on record. If you look at 2025, what's been happening since the Bessent administration came in, U.S. is the only like G20 sovereign where it's like sovereign debt rates are trending downwards. And that's just a sign of what's going on in the broader macroeconomic and dollar cycle. Thing I would juxtapose with that. So rates coming in, if we're actually doing a good job of everything we've talked about here, structuring, underwriting quality, right? Not doing speculative, DeFi crap that everybody was doing on their borrowing and lending in 2021, BlockFi stuff that's not blowing up. This is a key moment here in these next 6 months. If we did a good job as an industry, not just the 3 companies up here represented on this panel, but everybody in Bitcoin-backed lending, that should be trust earning with banks, pensions, insurance companies, like long-term credit capital that's coming in to deploy into the space. You will not get spreads down until you've earned their trust. So if we go through another one where we rug pull, generate losses on bad lending, that just delays that process into the future. So we can't get there to that lower rates, lower spreads world where everybody talks about pristine collateral, we have the best asset, et cetera. It's true, but you got to go out there and earn it with the actual pools of dollar capital to bring it in. So we're going to find out here in the next, I'd say, 3 to 6 months whether that trust was earned or not, and then we're going to build back up from whatever happens there. So it's a long game. You go talk to an investment committee, it takes a long time to earn their trust. It only takes 1 day to earn it. It's a long-term commitment. So I think that's what we're looking at here.
I have one additional thought to add, but as an aside, I think Wyatt has cracked the code for public speaking. You just have a really cute baby in the front row, and it calms all the nerves. Anyways, the Matt, we may be jumping a little bit ahead here. Maybe not. I get questions from clients all the time about like mortgages and like 30-year terms. And if you look at the space, not surprisingly, well, maybe surprisingly on the surface, terms are very short. Unchained offers a 12-month term, probably on the longer end is maybe 2 or 3 years. Point being, why is that? Think about the capital provider that's providing capital to these investments right now, especially this early. They are likely at least Bitcoin open-minded, right? The longer that term goes out, now you're dealing with an opportunity cost of, okay, I can put dollars into this investment that's Bitcoin adjacent and get a 10% yield or whatever it may be. But if I'm looking at 30 years, I have to outpace Bitcoin's performance over the next 30 years. And so you have to find the capital provider that's willing to provide capital instead of just investing and buying Bitcoin. I just wanted to point that out because that's a really important dynamic that is part of the reason I think why rates are still so high, even though we have had some institutional adoption.
Yeah, no, it's a great point, Connor. And gentlemen, just within our last closing minutes here, what's something you're excited about in your industry? What's something you look for from partners? What's something you're looking to see in the future?
Yeah, so especially as it relates to this room, we've been working with a lot of wealth managers, financial planners, and other such groups of people to really provide the benefit of our services to their clients. A lot of people do benefit from a loan or from a use case that is enabled by a loan. So our vanilla Bitcoin-backed loans have been around for a while. They're battle tested. We've done a few $100 million on those. But now we have the opportunity to go to different use cases and provide that benefit in a more managed fashion. So the first product we did there is focused on retirement. It's called Perpetual Income. Gives you new tax-free income every year against your Bitcoin you park up once. The second one is, it's going to be announced on Tuesday, but it's something that lets you borrow against your Bitcoin, go invest in something that allows you to depreciate the full purchase price against your taxable income. So now instead of owing $1 million in taxes, say you could probably owe $100K and be in a much lower tax bracket. And we'll go down the curve on different use cases we've learned from our clients and really provide those services. So I guess my only ask here would be if you are one of these people, a wealth manager, financial planner, et cetera, would love to speak with you after and find a way to partner. And I think what I'm excited about, one more thing, is I think we've all been in this world, holding Bitcoin hopefully for a while. And there's not much you've been able to do with that Bitcoin besides maybe get a loan from some companies here. I think now there's going to be a lot more you can do with it. So I'm quite excited about the utility that Bitcoin would enable, which really enables us to live on Bitcoin more and more.
I think the excitement comes from just being so early. A bunch of financial professionals in the room here. I think most are aware that the credit market dwarfs the equity market. And as early as we are in the equity markets, credit really doesn't have access to Bitcoin right now. And so we're just at the beginning stages. Everyone in this room knows that Bitcoin is the most pristine collateral in the world. It's appraised 24/7, 365. It's incredibly liquid. It's incredibly fungible. And point being, we are just beginning here, and it's going to be the backbone of the entire financial infrastructure. And that's the opinion, I think, of everyone on the stage here. And if we're right, obviously, the individuals up here are going to be, the companies are going to be some of the founding building blocks of the broader financial system, in my opinion.
All right. Thanks for giving me the last word, Connor, so I'll close it out here. I'm excited about America. Like, Bitcoin adoption in America. In Bitcoin, we understand the core problem, the debt problem, the deficit problem, the drug problem, all of that. We've got the answers. We just need to keep pushing for adoption. And that means just doing it right, lending right, get bank adoption, financial system adoption. But everything you see going on in the world, like you've seen the headlines this year, like things are moving towards this like fourth turning concept. We're coming into that nexus point. We've got an administration that is pro-Bitcoin. It's on us to build upon it. And I would say just use this thing to leave a financial architecture and a better union for our children, children's children's, et cetera, and on. So yeah, I'd say that things are going to get hot. It could blow off at any moment, but just keep your heads down, keep working, keep pushing for Bitcoin adoption, and I think it'll get us there. It'll be enough.
Thank you, gentlemen.
Thanks, Mike.
Thank you, Wyatt.